inflation, and 5 staggering effects it is having on America's economy. For Americans around the country, what I am about to say is no new news. We are officially witnessing a surge of inflation, the likes of which we have never seen in decades. Even the statistics, which has often attempted to paint a rosy picture of the situation in the past, agrees with this. The latest report from the US Labor Department indicated that the Consumer Price Index, or CPI, increased by 8.6%, its highest level since 1981, in May, effectively dashing any hopes that inflation was starting to resolve itself. The data from the Consumer Price Index for May is just the most recent indicator demonstrating that inflation is still high and has not yet reached its peak in the United States. To put it simply, the worst is yet to come. But let us look at the damage the surge of inflation has wreaked on the American economy so far. Before we begin, if you're interested in getting top-notch economic insights like this on your feed, make sure to subscribe to this channel. All done? Great. Now let's get to it. What is inflation? If you aren't very knowledgeable about economics and don't even have the vaguest concept of what inflation is, you might be wondering what all the fuss is about and why the news about inflation and rates is everywhere. Let's get into the nitty-gritty of it, shall we? Investopedia officially defines inflation as the reduction in purchasing power of a currency over time. This rise in the general level of prices means that a unit of currency effectively buys less than it did before. To put it another way, inflation means that something that could be purchased with $100 in the previous year will now cost more than $100 today. How is inflation calculated? Everyday items are used as a proxy for the economy to compute the inflation rate in most cases. These commonplace commodities could include things like clothing, food, or hey, even gasoline. After that, these commodities are included in what is known as the national market basket. The price of this basket is then contrasted against itself over the course of time to determine whether or not the prices are going up or down. If there was an overall rise in prices, then the economy may be described as being inflationary, and when there is a general trend towards lower prices, this indicates that the economy is in a deflationary situation. The rise in prices of products and services that people use on a regular basis is what causes inflation to occur. If the annual inflation rate of a country were to increase by even a meager 2%, this would indicate that the average price of shopping done in that year would be 2% higher than it had been the year prior. What caused the inflation? Although the government is blaming factors like the unexpected Ukraine war and other bottlenecks as the cause of this price surge, the truth is, ever since 2020, the threat of super high inflation has been growing more and more substantial, and the federal government let it happen. The threat of the US economy spiraling into uncontrolled inflation caused by unprecedented money printing, low interest rates, and wage hikes has been pointed out by many concerned economists and investors. As far back as a year ago, in an interview in May 2021, veteran investor Bill Ackman debunked the idea that the post-lockdown inflation was only temporary, as the Feds maintained.
So the key in a world where there's going to be inflation and there's going to be wage inflation is to have a business that sells a product where there's pricing power.
Where do you come down on that?
Yeah, I think it's not temporary. First of all, it's hard to roll back wages once you roll them up. I mean, you go from 15 to 12. You know, So I would say we have a new baseline in terms of wages, sort of generally.
To Ackman, the current inflation we're witnessing is not just an errant after effect of the coronavirus pandemic, but rather a new feature of a radically altered country that has seen a rise in the cost of minimum wages, 2 unprecedented stimulus checks, all resulting in an influx of fresh liquidity being pumped into the markets at a level and volume unseen before. Ackman rubbishes the idea of a gentle, quiet return to the traditional norm, and more or less advises anyone still holding to hopes that the current trend of inflation would go away to wake up to reality and accept the new order of things. And if you thought he was alone in sounding the alarm, think again. In 2021, Warren Buffett, speaking at a shareholder meeting with holders of the Berkshire Trust Fund, warned of very substantial, uncontrolled inflation hitting the U.S. economy.
Are you seeing signs of inflation beginning to increase?
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us, and it's being accepted.
Buffett talked particularly about the inflation going on in the housing sector, a sector he's deeply invested in.
Take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. There's more inflation going on than, quite a bit more inflation going on than people would have anticipated.
Unsurprisingly, the housing sector is one of the 5 hardest hit sectors, with an over 30% plunge in the sale of newly built homes and a collapse in the demand for existing homes. The housing and real estate industry is not alone in suffering from the recent misery the economic downturn has brought. Here are some other sectors suffering badly in the wake of the inflation crisis. Technology. Because of rising prices and waning demand, technology companies in the United States terminated nearly 9 times as many employees in May as they had in the first 4 months of the year combined. The worldwide outplacement agency Challenger, Gray, and Christmas stated in a monthly review report that the layoffs in the technology sector increased to 4,044 from 459 between January and April, the difference of only a few months. That is the largest number since December 2020, when tech companies eliminated as much as 5,253 jobs in total. According to the data from Challenger, Gray, and Christmas, fintech companies disclosed a 268% increase in the number of job layoffs in May compared to the first 4 months of 2022. Many technology startups that saw tremendous growth in 2020, particularly in the real estate, financial, and delivery sectors, are beginning to see a slowdown in users. Combined with concerns about inflation and interest rates, they are restructuring their workforces to cut costs. The impact of the crisis in Ukraine, a 4-decade high inflation rate, and rising interest rates has led to forecast reduction by corporations such as Snap Incorporated and Microsoft. Other companies, such as Meta Platforms Incorporated, have paused recruiting in order to bring costs under control. Stocks. When investors got a hold of the news that the US measure of the cost of living had hit 8.6%, the highest in 4 decades, they immediately took flight. Frightened at the possibility of tough actions to combat high inflation, the S&P 500 index, a broad measure of the health of the US stock market, has fallen 20% since its peak in January, while the technology-rich Nasdaq has dropped by 1/3. That is to say, so far, over $7 trillion. Yes, you heard that correctly, trillion, has been wiped away from the stock market this year alone. Tech stocks like Apple and Tesla, as well as entertainment stocks like Netflix, have taken a serious beating. And from all indications, the bleeding is set to continue. Tech companies are not alone in implementing devastating layoffs. Real estate firms have also fired off hundreds of staff in May due to slowing sales and increased interest rates. Redfin and Compass, 2 major real estate companies that focus on property technology, have revealed that they will be laying off a combined total workforce of more than 900 employees due to worsening market conditions. Redfin CEO Glenn Kelman said his company is laying off 470 workers, or 6% of its workforce, after May demand was 17% below projections. Kelman stated that in order to avoid having to lay off employees after only a few months of uncertainty, the company had successfully raised hundreds of millions of dollars. However, mortgage rates rose at a rate that was faster than any other time in recorded history, and the funds are just not enough. Redfin is still committed to achieving success despite the possibility that the slowdown in house sales could last for years rather than just months. If a decrease in the share price from $97 to $8 isn't enough to put a firm through hell, I don't know what is. he was quoted saying. In the meantime, Compass is laying off approximately 450 employees, which is equivalent to 10% of its total workforce. The layoffs come at a time when the once scorching real estate market is beginning to cool up as a result of high mortgage rates and inflation rates that hover around 6%. In May, the stock prices of both Redfin and Compass went down, with Redfin seeing a decline of over 5% and Compass experiencing a decline of more than 10%, respectively. Conclusion. The truth is, inflation is here with us and is probably here to stay throughout this year, and might even extend into the next year. The best thing to do is make very prudent financial choices that increase your income and minimize expenses to the barest minimum. What are you doing to hedge yourself against the coming storm? Let us know in the comment section below. And as always, thank you for watching.